We would like to thank you all for joining us for the second webinar hosted by the Annual Investment Meeting and in partnership with Connectology. My name is Prashant Odrani, conference producer for AIM, and I'll be your MC for today. I hope everybody can hear me properly. I'm just reading the chats if everybody can hear me. All right. All right. AIM is the largest investment platform in the world, an initiative of the UAE Ministry of Economy. AIM has been promoting a healthier global economy by linking investment opportunities to fast-growing economies under 5 key pillars: foreign direct investment, foreign portfolio investment, small and medium enterprise, startups, and future cities, with a special event, One Belt, One Road. Just a little housekeeping rules before we get started. If you have any questions during the presentation, please type them into the question box in the control panel on the right side of your screen. I'll bring them up after the presentation. During the webinar, we'll be running live polls located beside the question tab to keep you engaged. Today's topic is negotiating with investors during turbulent times. In this webinar, we will cover how to become resilient entrepreneurs, know how to negotiate with investors during crisis periods, discover how to get investments by doing risk mitigation. Let's start off with the first poll for today. Please click the polls tab, which is located on the right side of your screen. How difficult is it to raise money for startups because of COVID-19 crisis? Option A, less difficult than before the crisis. Option B, no change from before the crisis. Option C, more difficult than before the crisis. While we wait for you to vote, I'll introduce our speaker for today. We are joined by Paulo Andreas. Paulo is an international expert in entrepreneurship, angel investment, scaling up, and risk mitigation. In 2000, he participated in his first IPO as an entrepreneur through Novobase IPO in Euronext stock market. Since 2012, he has been holding a series of workshops on the topic of startups and investors' risk mitigation. He is currently finishing the writing of a book called Zero Risk Startup, to be launched in the last quarter of 2020. Without further ado, we will turn over to our speaker, Paulo Andreas. Paulo, over to you.
Thank you very much for the introduction. And I hope that everyone attending the webinar is safe together with your families as well. And we are in turbulent times with all these crises from COVID. And I hope that we can, through the webinar, give some tips and some tricks in order for the entrepreneurs that want to negotiate with investors, that they can have better chances with some of the tips that we will be talking about. So I would like to start by thanking AIM and also Connectology for the invitation to be in this webinar. And I would like to start with an overview how I see the current situation in terms of weaknesses, but also with some opportunities. So how I see that this COVID-19 is changing the startup funding market. First, in terms of the negative impact, many investors are experiencing losses in their activities, which reduces their liquidity to invest. So some of the people that were in the market investing, nowadays they are out of the market because they need to invest all the money they have in their current activities. Some investors also will see their startups investment fails, which means that some will be disappointed with early stage investment and they don't want to continue investing as angel investors. Of course, the risk aversion to invest in startups increased significantly. We have seen across the globe several numbers showing exactly this problem. And many established companies also will urgently need cash. This means that companies with clients, companies with very little risk in terms of the execution of the projects, they will be very cheap for investors to invest in these companies. This will mean that there will be strong competition for new startups. Of course, old companies or established companies, they have also some legacy. So if they need to lay off people, they need to pay those costs. So this is also a disadvantage for established companies. But between having a company with already established company that's ready to go to the market with clients and a new startup, many investors will prefer to invest in an established company. Of course, this also impacts the valuations of the startups. They are diminishing now, and due to the decline of GDP, they will also continue to decline for some time until the situation comes back to normality when we don't know when it will happen. And another problem for entrepreneurs, events like AIM and Slush, they were postponed or canceled. So this reduces the opportunity for entrepreneurs to talk with investors, and this is a problem. So how can they meet investors and how can they talk with investors? But as in everything in our lives, when there is something that is a problem or is a crisis, we can see also some opportunities, and that's what I wanted also to highlight in this webinar. So many governments are flooding, the world is flooding money to the market, which may help some startups to get loans or grants instead of equity investment. So I've talked with some startups and they said to me, look, there is now this money from the government. I will not apply for equity investors because I will prefer to have this money from the government. Some governments also are increasing their budgets to co-invest with angel investors and venture capitalists. So there will be more money in some markets in terms of these VCs and business angels. Some governments are providing more tax benefits to investors, and this also attracts some investors to the market or sustain the existing investors in the market. Not all sectors are down nowadays. Some sectors are very hot for investment, remote work solutions, e-learning, healthcare, logistics, e-commerce. So if your startup is in one of these sectors, probably you have better chances of getting funded than before. So your chances of getting funded by investors increased. Some investors are also in odd sectors with lots of liquidity. One friend of mine said, look, I'm making a lot of money because it's in the medical sector. And if you know some interesting startup, I would be willing to invest in the startup. So this means that not all investors are out of money or out of the market. There are some that have a lot of liquidity and they want to take advantage of this opportunity for them to jump into the market. And some investors have more relaxed agendas and may be able to accept a Skype Zoom call. All the travels were canceled, so they are at home and they have more possibility to talk with entrepreneurs. When there is a saying that when it rains, you can either cry or sell umbrellas. And I've seen many entrepreneurs being worried about the current situation, but there is always a way to overcome this situation. And entrepreneurship is about that, is to overcome difficulties with low resources. And we should not give up in trying what we want in terms of, in this case, fundraising for our startup. I think we will have now another question, correct? In the poll? Yes. So the question is, if you reduce the investors' risk, how will it change their willingness to invest? It will decrease their willingness to invest, no change, or it will increase their willingness to invest. If you come to the question area and answer, then we will continue. I will give you just 5 seconds to do that. All right, continue. So, Aditya, there are two reports that, in my opinion, are very important to analyze why investors do not invest in startups. I've seen a lot of people in the market telling entrepreneurs that they should focus on the potential of the project and not so much in terms of the risk of the investors. But before it was very, very important. And nowadays with this crisis, I think it has been increasing. But let's have a look in terms of these two studies, one from IBAN and one from CB Insights in the US. So in terms of the IBAN study, it was done in 2018. There was a question, what were the reasons why the investors didn't invest in some opportunities, why they declined these opportunities? And the first answer is not because the project didn't have potential. The first answer was that the project had too many risks. So the investors were not believing that the entrepreneur would be able to execute the project. The second reason was the valuation was very high. So the project was good, but the valuation was very high. If you see the potential at low return potential, only 7%. Only 7% of the investors didn't invest because the project didn't have enough potential. So basically the message is, don't focus so much in terms of the potential, but focus more in terms of reducing the risk to the investors. In the second, another question that was asked to the investors was exactly the question we have asked you in this webinar. If the project risks are reduced, your willingness to invest increases, yes or no? And the answer was, and this was before the COVID crisis, so 96.2% of the investors said, if the project risk is reduced, then I will be willing to invest more. My willingness increases. It doesn't mean that they will invest, but the willingness increases. So it's clear that the path for entrepreneurs to try to fundraise is to reduce the risk of the investors. Instead of you thinking about yourself as an entrepreneur and your needs and what your company needs, think about the other side. If you would be the investor, how would you behave towards a proposition that you are doing? And sometimes I ask this question to entrepreneurs that approach me and they say, oh, I would not invest. So they are honest. And if the entrepreneur would not invest in its project proposal, how do you want the investors to invest in your project? One important thing is, and this is a distinction, is the risk perception versus real risk. The risk perception is what people perceive as a risk, and the real risk is different. When entrepreneurs pitch to investors, sometimes they assume the investors know everything about the sector, know everything about the market, and the investors do not know everything about everything. So it's very important that you are aware and that probably the real risk is different from the risk perception from investors. And it's important that you try to reduce those risks, so the risk perception, in order to equalize to the real risk. If you just do this, this will be already a very important step when you talk to investors. One important differentiation in terms of concept is between a project risk and investment risk. A project risk is the risk of the project. If the company will survive, if the company will be successful, if the company will be able to come to life and execute the project. The investment risk means if the investors will see their money back. And this is very different. And sometimes, let me give you an example. Imagine in Malaysia, for instance, where the government gives a tax break to investors of 100%. This means that if an investor invests $300,000 in a project, and if the project fails itself, so if the company goes bankrupt, the startup, then the investor has received the $300,000 in a tax break from the government. So the investment risk for the investor is basically zero, but independently of the project risk. So for many investors, it's much more important, the investment risk, not so much the project risk. Of course, the project risk is a reducer of investment risk. If the project risk, if it's very low and the company is going to be successful, the investment risk will be lower as well. In this webinar, we will be focusing only on the investment risk. On the project risk, I will not be talking about the project risk, but as you see, Zero Risk Startup, I'm finishing a book that will be launched until the end of this year, is about Zero Risk Startup, where I cover all the risks that a startup face and how to mitigate and reduce those risks. But today in the webinar, we are just focusing on investors' risk and how to reduce the investor risk, because as we saw before, if we reduce the investor risk, the willingness of the investor will increase. So the first tip that I will be talking about 12 tips today. I try to condense it in these 12 tips. Of course, there are more tips, but we don't have time in this webinar to do all these tips. But the first one is prepare your pitch considering how COVID's strong impact on the economy will affect your project. If today you are not putting this part in your pitch, it's very unlikely that you will be able to fundraise, because all investors are worried about this impact in the market, and a lot of companies will go bankrupt. Your clients may not be able to buy the service from you, or they may not have the money. So please consider this as a headline in your project. Maybe you should start your pitch by explaining how this crisis can affect or can be an opportunity for your project. The second suggestion is turn one-time investment in milestone-related investment phases. And here I can give, let's say, in two different topics. Imagine someone that your startup needs a license to operate, and you are raising, let's say, $1 million. And if you come to an investor and say, look, I want $1 million and I will do this, and I will get the license to operate. Of course, the investor gets a little bit worried that you may not be able to get the license. But if you tell the investor, look, I want $1 million and I want your commitment, but your money will only come once the license will be issued. So there is no risk for the investor. So you reduced this risk. And I've seen a lot of entrepreneurs pitching to investors, telling, look, I need $1 million, I will do this, I will buy the machines, then I will expand to this city, then I will go to the second city, then I go third city, then I go second country, third country, fourth country. And of course, the risk to the investor is $1 million. But if you, instead of this one-time investment, if you divide and split this investment in terms of depending on milestones and performance milestones, then this gives you a better chance of fundraising. So imagine that you say, look, initially I will need $100,000 to buy this machine, and with this machine I will serve my city. When I have 5,000 clients, then I want to buy a big machine because this will help me to go to the bigger city. And this second machine is $200,000. But and then so on, so on. So when the investor puts the $200,000, the risk is very low because the first one is very successful, and even if the second one fails, the second city fails, the first one will make enough money to pay the investor back. So turn one-time investment in milestone-related investment phases. The third one that I would like to talk is about asset-based financing. So some of you are not familiar with this concept, but I've been using this concept in helping a lot of entrepreneurs fundraising. So imagine the following situation. You want to have online business to sell iPhones, mobile phones, and imagine that you will, if you buy 100 iPhones, instead of you paying for 1,000, let's say the market price is $1,000, and if you buy 100, you can buy them for 700. And so for $700 and you want to buy 100, you need $70,000. So one way to pitch to investor is, look, I need $70,000 and I want to do this e-commerce in terms of this selling these iPhones. This is super risky to the investor because he doesn't know if you will be able to sell these iPhones, etc. Another way to do this is to say to the investor, look, you buy the iPhones, so you will get this, all your iPhones will be in your warehouse. Every time I have a client online, I will come to you and I will put the money in the bank account, and then you will release this iPhone. So the risk of the investor is to get all these iPhones in their hands, but he will not lose all the $70,000. And if you want to reduce even further the risk of the investor, you can also find some potential buyers that will buy the iPhones at any moment. So if you go to a supermarket chain or electronic chain in your market, and imagine that you get a guarantee that at any time this investor can sell the iPhones for, let's say, $650, this means that the risk of this investor will be $50 per iPhone. So times 100 is $5,000. This reduces dramatically the risk of the investor. And for you, you make your startup and you will be able to do this project together with the investor. Another thing that you can use this asset-based financing as well is with fixed assets. So imagine that you need to buy a vehicle or a machine, and instead of you asking the money from the investor to put in the company, then you buy the machine, and then the machine belongs to the company. But if the company goes bankrupt, the machine goes, you can say to the investors, look, you buy this machine, the machine is yours, and I will be using the machine until I pay the machine back to you, or something like this. This is also possible. Another possibility is if you are going to produce some products, then you can also give as collateral some of the products that you are going to produce. So you say, look, I need this money and I will produce this number of these products, and the products will be yours, so I will put in your warehouse afterwards. So if the company doesn't sell, at least the investor has this product. And in some cases, I've seen deals where the investor has some big corporates, and the investor says, okay, even if the company fails, I get these products and I will just offer these products to my clients in my corporate. So the risk to the investor is reduced. Let's move to the fourth one, which is the public-private co-investment schemes. Here, some of you may have heard about co-investment schemes with governments, and this is exactly one way that the investors have their investment risk reduced. How? In some cases, the governments can put 50% of the money to co-invest together with the investor, or even sometimes more. Imagine that an entrepreneur needs $300,000, and you approach an investor and say, look, I need $300,000. Do you want to invest? Another way to approach the investor is to say the following: look, I need $300,000, but the good news is there is this co-investment scheme from the government, and you will only need to put $100,000, and you may buy back the part of the government with the upside for you. And this is something really interesting, because for the investor, he will just invest 100,000, but he will be able to reap the benefit of investing as 300,000. These co-investment schemes exist in Europe, in United States, and in some countries in Asia as well. For instance, in Europe, we have the European Angel Fund from the European Investment Bank. In Portugal, we have these co-investment schemes that the government invests 65%, together with investors 35%. In UK, there is the Angel Co-Fund, where the investors get 50% from the government, and in terms of the as co-investment. And this is a very good way. So my suggestion is try to find if in your country there is these public-private co-investment schemes, and when you approach the investors, you bring already this opportunity for them. Another way that, of course, also reduces the investor's risk is the investor's tax breaks. Many countries, as I mentioned Malaysia before, but many countries have these investors' tax breaks, which means that if the investor invests in an early stage company, SME, not quoted in the markets, then the state will grant a deduction on the investment that was done. In some cases, you can deduct 30%, 50%, or 100%. So if in a country you get this 100% tax break, then basically the risk of the investor is zero. Of course, sometimes this means that some entrepreneurs don't find these kind of schemes in the countries where they are from, and they need to move to another country. And that's sometimes a challenge, but I've seen some entrepreneurs making this happen in a positive way. Another situation where you can also reduce the investors' risk is through governmental COVID-19 loans or grants. Some governments across the globe, and every day more and more, they're flooding the market with these loans and grants. What happens sometimes, they need the private sector or the investors, the entrepreneurs or the owners or the businessmen to put some part of the money. But if you don't have this money, then you might try to find investors. But it's completely different. Imagine that the government puts 80% of the money as a grant or as a loan in your company, but you need to get 20%. And in the case that we were mentioning about $300,000, what we see is, instead of you approaching an investor asking for $300,000, you say, look, we need $300,000, but through this scheme of the government, I can get 240. Can you invest $60,000? And this reduces immediately the risk for the investor, because the investor, if he has $300,000, he can invest in 5 businesses and spread the risk alongside those investments. So my suggestion is try to find if in your country or in which countries there is these loans or grants, and try to talk with investors already with a solution, and that it's easy for the investor to move on. Another suggestion that I would like to bring is bridge financing for guaranteed liquidation event. Of course, this is not for all companies, but if you are about to list your company in a stock market, if you have a company willing to buy you, or if you have a guarantee that a company can buy your premises. So imagine that the project is that you do a factory and you already have a buyer for the factory. So when you approach an investor and you show that this guaranteed, and guaranteed in commas is in brackets, is showing that is maybe not 100% guaranteed, but 90%, 80% guaranteed, the willingness of the investor to invest is much higher because he sees that there is a real possibility. Of course, there is always some risk, but we are here to try to reduce the risk, not to make it completely zero. The eighth suggestion tip is about the revenue-based financing. And this revenue-based financing is a model that probably some of you are not familiar with. And how does it work? If your startup has, let's say, stable or guaranteed revenues, and you do not want to sell your company, you don't want to give up equity of your company, then you can apply for this revenue-based financing. Imagine a software company that has already some clients paying, and for, let's say, for 2 years, but now this software as a service company, let's go like this, wants to expand to another country. So if the company, the entrepreneur wants to expand to another country, needs some money, and if you go to the bank will ask you personal guarantees, and you don't want, and you don't want also to give up equity, then you can approach some companies that work on this revenue-based financing. So they will give you the loan, let's say $200,000 or even your $300,000, and they will agree with you a royalty based on the sale. So every time you sell something, you will pay a royalty to these companies, and this royalty can range from 1% to 20%, where on average we are talking more or less between 6 to 10%. It depends on the sectors, it depends on your margins, but so every time you sell something, you pay this amount to the investors. The advantage until a cap, and the cap usually is between, I would say, 135x to 3 times X the money that they have given you as a loan. So let's call, if you ask the $300,000 and you agree with them that is 2x, so when you pay them $600,000, the loan is repaid, and you don't need to repay to pay anything else. The advantage of this model for the entrepreneurs are, first, there is no valuation of your company. It's no one asks how to value your company. You don't need to go into this situation. You don't need to give up in terms of equity. You don't give personal guarantee. If your company is hugely successful, you will benefit from the upside above the cap. So you are not sharing the huge upside of the company. You will not have these investors in your general assemblies voting against you or not agreeing with you, and of course you will keep 100% of the equity. A big advantage of this model as well is that the entrepreneurs the company will never go in default. Why? Because if you don't sell, you don't pay. So only when you sell, you will pay the investors. The advantage for the investors for this model is that the investors start receiving their money immediately next month. So if your company is working and receiving normally money from the sales, the investors will start immediately receiving. So the exit for the investors starts 1 month after they have invested. This is fantastic for them because they can take this money and invest in other companies as well, and they don't need to have a liquidation event where you sell the company and you need to find a buyer and all these problems that you are aware of. Of course, for the investor, the disadvantage is that they will not be having returns of 10 times, of 20 times, or 30 times as they would like to have. So their returns are much lower, but they are on a more safe side, if I can say, and their risk is much lower. So for very risk-averse investors, you may try to bring this opportunity for them. If you are in Europe, for instance, you can contact a company called Uncapped. If you are in other places, you can contact one company is Lighter Capital, that is one of the companies that is doing this, or Clearbank also does this in Canada. Let's move to the ninth suggestion is help to option. So the first thing that when you start fundraising is to understand if you really need the money from investors or not. Can you get, if you get clients paying, do you still need investors? Sometimes there are clients that are willing to buy software for you to design the software and develop the software. So you have a first client, and then from there you can get other clients. So you can reduce your risk. So if this is the case, why not, instead of getting directly to investors, why don't you try to approach some people that know potential clients and offer them the following: look, if you get me these clients, I will give you a certain percentage of the sales, like a commission, so that you can get this money. And the same thing for some kind of people that know investors. And nowadays, because these events are not happening worldwide, it's more difficult to meet face-to-face these investors and to know where they are. Maybe you can talk with some people, say, look, if you are not interested, can you help me find an investor? And if you find an investor, I will give you some shares in the company, or I will give you some money from the money that will come from the investor. So this is help to option is a way that will also help you to bring some money to your startup. The 10th option is, I like this one very much. So this name, option to invest, I made it up myself. And why did it happen? Because I received many deals, and when I was negotiating with some entrepreneurs, I didn't know if the market was willing to buy the product or services from these entrepreneurs. So in order for me to mitigate my risk, I said, look, I'm going to open some doors to you and see if the market wants to buy your product or your service. And what happened in many cases, they did the deals, they did the sales, but they never called me back. And they never eventually said, thank you, your contact was fantastic, you were absolutely great. No, not even a thank you. And then I start thinking, look, but why am I giving all these contacts and my networking for free, and I'm losing time? Because sometimes I spend days talking with entrepreneurs, and in the end, after everything is ready, they go to talk with the clients, and then they don't come back to me. So I lost my time, and my time is a very important asset that I have, together with my network. So I start talking with the entrepreneurs, say, look, let's do something that is fair for you and it's fair for me as well. I will open some doors to you. And if you are able to do sales in these dimension in terms of these amounts, then I, as an investor, have the option to invest in your startup at this valuation, at these terms. And if I don't, if through my contacts you are unable to get these sales, then you don't have the compromise to have me as your shareholder, and you don't take this risk, because you know entrepreneurs promise a lot of things to investors, but investors sometimes promise a lot of things to entrepreneurs, which they are not true as well. So you as an entrepreneur must be aware that when an investor promises you that they will open this door or that door, you should put this in paper and say, okay, if you don't open these doors, or these doors do not happen the sales as we expect, then I may not accept your money as an investor. Because some investors try to get a discount in terms of valuations because they add value. But if they don't bring the value, then you end up giving a huge discount to investors that will not bring the value that you were expecting. So this option to invest is perfect for both sides. You don't have anything to lose, because if the doors that will be open will not materialize in sales, then you don't lose giving a discount to this investor. And the same for the investor. The investor will be willing to open a lot of contacts because he knows that, or she knows that he or she will be protected if you make these sales. So this is something that reduces the risk to the investor instead of just putting the money up front. So instead of putting the money up front, you say, okay, let's see if the market wants to buy, then you buy with less risk. The 11th is about valuation. As you remember, in one of the first slides, I've shown you this result why investors do not invest in startups. And the second reason was valuation. This means that some entrepreneurs have everything perfect. They have clients, the project risk is very low, but they ask a very high valuation. We could do a full day seminar about valuation. I've been doing these seminars on valuation just a full day, so we don't have time to enter in a lot of details about valuation, but I will give you some hints about the way I see the valuation. So if you have been in an MBA or in an economic school, you have been taught that there are 1 million different ways to value a company. The problem of a startup is that you don't have guaranteed returns, in guaranteed sales or returns based on the past, because in the past the company didn't exist. So basically, it works like you do your projections, and based on your projections, then there will be a model that says what is the value of your company. So when I discuss this with banks and people that suggest the entrepreneurs to buy their services, to do these valuations, I always ask the same question to them. Do you know, so you have been working doing these valuations for 10 years, so it's absolutely great. Can you tell me one company that you did the valuation to, and that the valuation, that the company, the performance of the company was exactly as was expected by the entrepreneur when they did the forecast of sales and the profit? And they say always, no, I don't have any. So basically, any projection and your business plan, entrepreneurs, they are wrong. They are not going to happen. So it's going to be better or worse, but exactly as you expect, it will not happen. So it's hard for me to understand that something that is wrong, so wrong data as an input, there is some MBA schools and some consultants say they have a miracle process that with the wrong data, they come with a good valuation, a correct valuation. So for me, it's really, really strange. And I was the way to manage this is, of course, not focus on being on the speculation in terms of what will be the revenues of the company in the future, but being saying if this happens, if that happens, then the valuation is this or that. There is Derek Sivers in US. He has a very good quote saying that ideas are just a multiplier of execution. So a brilliant idea with no execution is $20. So you can have the best idea in the world, the best team in the world, the best product in the world, but if you don't have clients, if you don't execute them, nothing happens. Your best of everything is worth $20. And so execution is everything, but in the execution it depends on the future, not in the present. So how can we do this? You have a business plan that you believe, and so let's assume that this is your business plan in terms of sales, which means that on the year 3 you will have $4 million of sales. So let's assume that this is the business plan that you present to your investors. And on a normal way or traditional way, you take this to a bank or to a consultant, and they will do discount cash flows or other methods, and they will say that your company, your project is worth 3, 4, 2 million pre-money value. But and this is not wrong, but if this happens, the value is correct. But the problem is if this does not happen. And what you are talking to investors usually is to say, okay, I projected this. This is the valuation based on my projection. But if my projection will not happen and it will be worse, it's your risk, investor, to invest. And of course, this brings a lot of risk to the investor. And usually entrepreneurs and investors start gambling and being speculators in the beginning when this brings a lot of risk. And this is like a marriage where someone will be upset in the end. If it happens better than the entrepreneur initially thought, then it will be the entrepreneur will not be happy because he negotiated based on a different curve. But if it will be worse, then the investor will be upset. So instead of this game there where someone will be upset and brings a lot of risk, what you can agree is with the investor is earn-out clauses, which means that you can agree in the beginning, let's say in a situation that you put 20% of the money, let's assume this, but because you have worked this so much, you want 50% of the company. So instead of asking 50% up front of the company, you tell investor, look, I will start with 20% because I will put 20% of the money. You will put 80% of the money. But in 3 years' time, what we have seen before, if I get these €4 million sales, then I have got 100% of my goal achieved. And if I get this 100% goal achieved, then you, investor, will give me 30% of the shares. So basically, in the end, I will get 50% of the shares. The same, it applies for the opposite. I can say as an entrepreneur, say to the investor, look, I would like to start with 80% of the shares and you get 20%, despite you put 80% of the money. But during a lockup period, let's say like 3 years, we will not sell shares. There will not be increase of equity. So you will not be diluted. And in 3 years, if I get 100% of the goal that we have agreed, then I will give you 30% of the shares, so you'll get 50%. So if you agree on these terms, no matter how you start, what matters is how will you end in the milestone that you have agreed. And in this way, no one is tricked, because it's not based on your projections, it's not based on your speculation, it's based on reality. And when it's based on reality, people tend to it's fair for both sides. The last one, of course, if all the others didn't work, then you need also to reduce your project risk. I will not come to this project risk now, but as I mentioned, I'm writing this book. I will be publishing this book, and I will cover basically the 5 risks of any project, which is the market, the legal, the entrepreneur, the operational risk, and the financial risk. This is the 5 risks of any project, and based on those, you can reduce your risk a lot. Thank you for listening to me. I think I've made the time, and I will have some questions now. And go ahead.
Thank you, Paolo. We will go ahead and take some time for questions now. Just a reminder, please be sure to type your questions into the question box in the control panel. If we are unable to answer your questions, Paolo will address the unanswered questions after the webinar, and we will send you his response after the email. So Paolo, let's just go to the questions tab, and let's take a look at the first question. I'll take the upvoted ones here. You mentioned in your presentation public-private co-investment schemes as the way to reduce risk for investors. Can you detail a bit more why governments create this type of schemes, and give a concrete example of how investor risk is mitigated?
Look, the problem for the why governments do these co-investment schemes, it's very easy. I don't know any government that is good selecting projects to invest, and they also don't want to be alone. So for a government, instead of the government invests $20 million in companies, if the government co-invests together with the investors, these 20 million can come to 60 million or even more. So this will attract more money to the sector. So this will reduce the need of the government to invest the money. The second reason why the governments also do this is one thing is to put money in the company, but usually to spend the money is not a problem for entrepreneurs or for the company. But when there is a problem in the company because there is lack of market, there was disagreement between the founders. Who is there? Is the government? No, no one is there. So if there is a private investor there, this private investor will support the company and will try to figure out a way to make this company successful. So private investors for the government is very, very important. And the government also reduces fees for consultants, because sometimes the governments make programs to have consultants helping companies, startups. But what you see there mainly is consultants sometimes trying to receive just fees, but they don't care really about the company. But when the investors put their own money there, they have skin in the game, and that's completely different. So these are the reasons why many governments. There is a report from OECD that says that if one country wants to co-invest, to have a lot of angel investment, the best way is to do co-investment schemes.
Okay. Do you see this prominent in any of the regions? Like, which are the regions which are prominent?
I would say nowadays half of the countries in Europe have already co-investment schemes. In Portugal, in Spain, in France, in UK, Germany, at European level. So the European Angel Fund from the European Investment Fund,
Yes.
as I mentioned, in US there are co-investment schemes. So this is the best way, because the money when the government creates a co-investment scheme, the money goes directly to the startup. So it goes all the money from the government goes to the startup. And this is a very good way for the government to put money in the startups and get free mentoring and free advice from the angel investors.
Okay.
It's a win-win game for everyone.
Brilliant. Let's go to the next question. That's from Marvin. In terms of risk, in your opinion, how will investors assess risk with now with the pandemic risk being all over the world and obviously more devastating more than other risk categories.
Can you repeat the first part of the question? Because
In terms of risk, in your opinion, how will investors assess risk now with the pandemic risk being all over the world,
okay,
that which is being more
yeah.
devastating?
Yeah, so it depends on the sectors and in terms of the projects. There are if you come with a solution for extraction kits, for instance, that for the tests now the countries have tests, but they don't have extraction kits. So if you have a project that can produce extraction kits for these tests, this is super interesting for investors. If you have solutions for remote work. Solutions, this is also very interesting for investors. So I see very hot sectors in the market, and I've mentioned them. But of course, they will take in consideration this COVID situation and how people behave and what will change in the world after this crisis. So the important thing is you address this and how your project can survive on this crisis. I
Okay.
see we have many questions.
Yeah, we have a lot of questions, so I don't think we can address all of them because of the time. But let's just go through one more question. Yeah.
No, it's okay for me.
It's okay. Okay, let's just try to do one or two more questions. Yeah.
Okay.
At these difficult times, do you suggest crowdfunding will be a good option for startups?
The crowdfunding, you mentioned
Yeah,
crowdfunding?
crowdfunding. Do you think that's a good option at this time?
Yeah, it depends on what crowdfunding. As you know, there are 4 types of crowdfunding. There is the equity crowdfunding. There is the reward crowdfunding that you have platforms like Kickstarter or Indiegogo where you sell your products. So I think the equity crowdfunding, people are more risk averse now, and you see already in several platforms it declined. But it does mean that if you have a project once more that is related with this crisis and the project can survive in this crisis, then I think you can go crowdfunding for sure. I don't see any problem there. On the reward crowdfunding, I think people are at home and people have more time to buy. So e-commerce is growing. I think it's a fantastic way to do is crowdfunding and go Kickstarter, Indiegogo, and try to sell. And basically, you don't have anything to lose because the cost of doing this crowdfunding campaign with videos, etc., maybe is $3,000, $4,000. And if you don't sell, nothing happens. So at least you should try. For sure, reward crowdfunding is a good way to go.
Yeah, yeah. Now people at home, so I think there'll be more eyeballs towards any platform. Let's go to the last question. Yeah, last question
Okay.
for today. Are investors influenced with geographical location? For instance, countries like South Africa, if investment risk is very low. So, do you think geographical locations play a role?
In terms of that the risk of investment is very low.
Yeah.
In South Africa.
Yeah, they have given an example of South Africa.
Okay. I mean, I don't think that there is any country that says that the risk is very low. I think in all the projects depend on the execution. So it's once more, it's not about the potential of the project, but it's about the execution. You can have a fantastic team and a fantastic project, but if you don't execute, nothing will happen. So I think the risk aversion is everywhere. I've been in South Africa. I've been delivering master classes for angel investors in South Africa, and I didn't see any difference between South Africa angel investors to the US or to Europe. They basically behave the same way and think the same way.
No, okay. Sorry, it was mentioned Southern Africa, not South Africa in person. So Southern Africa side, yeah. Let's just take one more last question, yeah, before we do it, yeah. Investors require for early stage basically the effort of an established company to prepare investor materials. startups must lift all resources to this field. Naturally, have a deficit on product and quality. Why can't investors change focus on project itself and organizational potential?
You mean that the entrepreneurs are focusing on fundraising and not working there? Yeah, I think there is one problem, generically speaking, about the entrepreneurs is that they focus 80% of their time and attention to pitch for investors, but in reality they don't mitigate the risks. So the project, when it arrives to the investors, it's full of risk, and it takes a lot of time to the investors to fundraise them. So I would suggest that 80% of the time is to mitigate the risks of the project or the investment risk. And when they have done this mitigation, then they can approach the investors. And that's something that I would suggest. Another thing that is implicit in this question is who should do the pitch. If I receive a pitch that was done by one of the big five consultancy companies and everything is perfect, the slides are beautiful, and but when I talk with entrepreneur, I understand that the entrepreneur doesn't really understand what's going on there. I don't feel comfortable. I prefer an entrepreneur that writes something in A4 page, not even with the spelling mistakes, let's call like this, but I feel comfortable because this is the original entrepreneur, and I can count and I can see what I can count on. But if I see something very perfect, but just the surface, but on the content, it's not that perfect, I feel worried, and I will just will not invest. So it's very important that you approach the way you are.
Okay. Thank you, Paolo. Unfortunately, we are running short on time. And as mentioned to you earlier, we'll be reverting back to you on your queries via email. Paolo, is there anything else you want to say before we wrap up the webinar?
No, if you want to connect to me and ask a question, you can send me. You can find me in LinkedIn, Paulo Andres. It's very easy. Or if you want to, you can also in the zerorisk-startup.com, the zerorisk-startup.com website. You can also find me there and post me, so you can I can be in contact with you as well.
Okay. Thank you, Paolo. Thank you so much for this great webinar today. And thank you everybody for joining us today. We appreciate you being here. To download today's presentation or to register for our next webinar, which is scheduled for the 16th of April, please visit our website, www.aimcongress.com/webinars. Also follow us on our social media channels to keep yourself updated. We welcome your feedback via 3 live polls, which you will be viewing on your screens right now. This is just a feedback poll. We just want to hear from you on how do you think today's webinars went. Thank you once again for joining us today, and we look forward to seeing you on the 16th. Thank you, Paolo.
Thank you. Bye.